Commercial loan pre-qualification, what to know before making an offer. And finding the right commercial property could take months. But once you find the opportunity that you want, the financing conversation can suddenly become very real and very fast. And that's why commercial loan pre-qualification should often happen before you make an offer and not after. So whether you're purchasing an investment property or acquiring an owner-occupied building, or expanding your business, or evaluating your next commercial real estate investment, understanding your potential financing structure before signing a purchase contract can put you in a much stronger position. And pre-qualification does not guarantee that your commercial real estate loan will close. It can, however, help answer one of the most important questions before you make an offer. And how much property can I realistically finance? And what is commercial loan pre-qualification? Excuse me. Commercial loan pre-qualification is basically a preliminary estimate of the borrower and the property type and the proposed transaction and potential financing structure. So before a lender issues a final approval, there would normally be much more extensive and in-depth underwriting. And depending on the transaction, that will include an appraisal and an environmental report and title work and property financials and leases and borrower financial statements and tax returns and credit review and entity documentation and due diligence. But pre-qualification happens much earlier. And really the objective is to determine whether the proposed transaction is going to appear to fit the general requirements of a potential commercial lender and what their financing could potentially look like. So that may include estimates for the loan amount and the loan to value ratio and the interest rate ranges and what amortization is available in the loan term and what banks and lenders are requiring for debt service coverage, but also required equity and recourse structure and potential loan programs, but also what closing costs and reserves you would need. So instead of negotiating a property purchase without actually knowing the financing is going to work, you may begin the process with a preliminary financing strategy already in mind. So why get pre-qualified before making an offer? Well, one is you get to understand your buying power. And one of the biggest advantages of commercial loan pre-qualification is understanding approximately how much financing could be available. And commercial lenders rarely determine loan size based solely on the purchase price. And for an investment property, lenders may evaluate the property's net operating income or NOI and the resulting debt service coverage ratio and DSCR, but then also loan to value ratio and debt yield and occupancy and tenant quality and lease structure and property condition in the market. So for an owner-occupied property, underwriting may also depend heavily on the operating company's cash flow and the ability to service the proposed debt. And a preliminary financing analysis can help establish a realistic acquisition range before you spend significant time negotiating on properties that may not support the required loan you need. Two is you can estimate your equity requirement. And a $2 million property does not necessarily mean the lender will provide the same percentage of financing on every transaction. And equity requirements can vary considerably depending on the property and the borrower and the lender in the loan program. And a conventional commercial real estate loan might require significantly more equity than, an owner-occupied SBA structure, while bridge financing may be structured completely different from that altogether. So knowing the likely equity requirement is going to help you determine whether a transaction fits what you have available as far as capital. Three is it strengthens your offer. And commercial sellers want confidence that the buyer is going to be able to perform. And a buyer who's already discussed financing and provided preliminary financial information and established a potential lending strategy may present a stronger profile than a buyer who intends to begin searching for the financing only after a contract is executed. And pre-qualification can be particularly useful when multiple buyers are competing for an attractive commercial property. Now, it does not replace proof of funds or a lender commitment, but what it does is it demonstrates your preparation. Four, it helps you avoid financing surprises before due diligence is over. So imagine putting a $3 million property under contract expecting 75% financing, only to discover that lenders are coming back at 60%, is what they need to be able to service that debt. And that creates a substantial equity gap. And pre-qualification cannot eliminate every surprise because final underwriting really depends on the property and complete borrower documentation. So, however, analyzing likely financing before making an offer can help expose problems ahead of time. And that gives you the opportunity to adjust the purchase price or the financing structure, the equity contribution, or even the property to pursue if that's not a fit. So, what do commercial lenders evaluate? Well, every lender and loan program is different, but several factors commonly influence commercial real estate financing. First is property cash flow. For income producing commercial real estate, the property's ability to service its debt is critical. And lenders typically calculate the debt service coverage ratio, which compares net operating income with the annual loan payments for the loan. And if the property cannot generate enough income to meet the lender's debt service coverage requirements, the maximum loan is going to have to get reduced, regardless of the property's purchase price. Loan to value ratio. So loan to value compares the loan amount with the property's value. So say, for example, if there's a $1.5 million loan against a $2 million property, that represents a 75% loan to value. However, the maximum LTV permitted by a lender does not automatically mean that the property is going to qualify for that leverage, and cash flow and underwriting constraints can produce a smaller loan amount. Borrower's financial strength. And depending on the financing program, lenders may review liquidity and net worth and credit history and post-closing reserves and real estate experience and global cash flow and contingent liabilities, but also their existing real estate holdings. And the strength of the sponsorship group can influence both the loan eligibility and the structures that are available. But property type is another one, and not every lender has the same appetite for every asset class. And financing will vary for multifamily to retail to industrial to office to self-storage to hotels to restaurants to medical properties to mixed-use buildings to owner-occupied commercial properties and to special purpose real estate. And it's important to match the transaction with lenders that are actively interested in that particular property type, and that's an important part of our financing process. Investment properties versus owner-occupied. It's a different pre-qualification. And commercial pre-qualification also depends on how the property is going to be used. So for an investment property, lenders are generally focused heavily on the property's level economics like NOI, DSCR, occupancy, leases, market conditions, and its valuation. Whereas for an owner-occupied commercial property, the operating business becomes the major part of the underwriting. So depending on the eligibility and the transaction, an owner user may potentially evaluate conventional bank financing as well as programs like SBA 7A or SBA 504 financing. And this is one reason commercial borrowers should evaluate multiple financing structures rather than assuming one loan product is appropriate for every transaction. So what should you prepare for commercial loan pre-qualification? You do not necessarily need a complete closing package to begin the conversation. However, the more accurate information you provide, the more useful the preliminary analysis can be. And for an existing property, helpful information may include the purchase price, the rent roll, the trailing 12 months operating statements, the property type, the occupancy, the leases, and an offering memorandum. And borrowers may be asked for information regarding liquidity and net worth and credit and experience, existing debt and available equity. And business owners pursuing an owner-occupied real estate transaction may additionally need business financial statements and tax returns. And the objective is simple. Give the capital advisor or your lender enough information to evaluate the transaction realistically. And remember, pre-qualification is just that. It's not a final loan approval, and the distinction is important. A commercial loan pre-qualification or preliminary quote or capital match or financing discussion is not the same thing as a final loan commitment. And terms can change as lenders receive additional information and complete their underwriting. And final financing may depend on satisfactory review of items such as the appraisal, the environmental due diligence, the title, the leases, the borrower documentation, the property condition itself, the credit, financial statements, and lender's approval. So think of pre-qualification as an early financing roadmap and not a guarantee. So why shopping multiple commercial lenders matters? Well, commercial lending is highly fragmented, and a local bank may like a transaction that another bank declines, and a credit union may offer a different structure. And an SBA lender may view an owner-occupied acquisition differently from a conventional lender. And a bridge lender may consider a transitional property that requires stabilization before permanent financing becomes available. And this is exactly where access to a broader commercial lending marketplace can become valuable. And through CommLoan, borrowers can evaluate commercial real estate financing opportunities across a network of lenders and loan programs, rather than relying solely on one institution. And the objective is not simply to find a loan, it's to identify the financing structure that actually fits the property, the borrower, the investment strategy, and the business plan. So my suggestion is to get the financing conversation started before you make an offer. And I'm your guy, glad to help. And the best time to discover a financing problem is usually before you're knee deep in due diligence, with your earnest money gone hard and legal expenses, third-party reports, and a closing deadline approaching. And commercial loan pre-qualification can help you understand your potential borrowing capacity and estimate the required equity to identify the appropriate loan programs and to approach negotiations with greater confidence. So if you're considering purchasing commercial real estate, let's start the financing conversation while you're evaluating the opportunity. Know your numbers, understand your options, and then make the offer. My name is Bill Rapp with the CommLoan Empower Program, and I do commercial real estate lending well. Thank you for taking the time to watch. You can visit my website at billrapp.comloan.com. I appreciate your time. You have a good day.